From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, March 18th. You're listening to the Macrocast. This is Tony Fratto with Hamilton Place Strategies. As always, we have John Fagan and Brendan Walsh at Markets Policy Partners with us, and also excited to have Brai Odion-Esene with us today from SW4 Insights. I was near the SW4 last week in London. Brai is with us because it's this is Fed week. It's FOMC week. We had a presser earlier this week. John Fagan, why don't you give us a take on this? Just say that this is the day we've been waiting for a while. It was Fed raise day, first time since 2018. And what's your take on it?
Yeah, that's right. The first time since December 2018. That was an ill-fated rate hike, that last one in the tightening cycle, after which the Fed was forced to pirouette to hastily into a loosening posture as the U.S.-China trade battle heated up in 2019. This is obviously a very different circumstance, an incredibly difficult backdrop. Chair Powell alluded to the degree of uncertainty in the forecast, but essentially into this very challenging context with inflation risks, now questions about stagflation, the impact of high gasoline prices in particular on the consumer. We talked last week about consumer surveys flagging and questions in the market about the Treasury yield curve not necessarily flashing red, but flashing more growth concerns. Certainly, markets expressing some tension and some concerns around the growth picture and just the geostrategic outlook. And the Fed waded into this macro morass and basically hit the ball right down the fairway, I think is a fair way to state it. The projections were probably a little bit more hawkish maybe than market participants thought, but market participants were already that's the way that the futures had been pricing rate hikes, steady 25 basis point rate hikes at every meeting this year. And that's essentially what the Fed kind of ratified. So it was also, Chair Powell emphasized, I think, importantly, that the Fed is being cautious. They're looking at both sides of the risk. They expressed confidence in the strength of the economy and tried to quell concerns that they would be pushing the economy into a recession potentially to deal with this inflation problem. Chair Powell really didn't concede any ground on that point. And focused on just how strong the U.S. economy is now and how the labor market can withstand some modest and determined but modest and gradual Fed tightening. So overall, the equity markets liked it. The bond market looked, it wasn't too much more volatile than it's been, a little bit on the hawkish side, but still that kind of flattening aspect in the yield curve gives everybody a little bit of concern in the background. It's just a tough environment for the Fed, no question.
Right. If you'd been in that room and had a chance to ask Powell, is there a question you would have liked to ask that you didn't see asked?
So I listened to the press conference and I went over the transcripts of the discussion afterwards. And I do think one thing that struck me, and he did try to push back on this, but the question I would have asked him explicitly, just to get his take on it, is his thoughts on everyone treating the quarterly projections that the FOMC releases, which are, basically these are medians of everyone's individual projections. Yeah. They sort of combine and release as one thing. His thoughts on everyone treating them as FOMC projections, right? All this report is it's a summary of each participant's thoughts on the direction of inflation, employment, GDP, and future rate increases. But everyone just takes and thinks, the FOMC is saying we're going to see this much growth next year. We're going to see this much unemployment next year. We're going to see this much inflation next year. I feel like it tends to mislead a lot of folks as to the potential direction of future monetary policy because they treat these projections as a joint collective FOMC forecast. When in actuality, these are just medians that are trying to capture everyone's diverse thinking on the economy. So I would have loved to get him to explicitly explain to folks that this is not, in fact, one body's views. It's just trying to capture what are very diverse views in that room.
That's a really good point. And the diversity of views is clear with St. Louis Fed President Bullard, who's been he's been the vociferous hawk out on CNBC advocating for 3% policy rate by year end, faster and more aggressive hikes, balance sheet reduction, and so forth. He's certainly been leading the charge on that front.
Yeah, and it comes to another question, back to Tony's original question to me about what I would have asked, is that I've been told in the past that when you're monitoring Fed speak, besides obviously following the folks who are actual voters on the committee at any given year, is that really when it comes to policy directions, it's the chairman, the vice chairman, and the president of the New York Fed, right? So I've got to put Powell on the spot and said, your colleagues are always out there speaking about what they think policy should be. Should we be listening to every bloody person that comes on and says, I want a 50 basis point rate hike, right? Like, should we be ignoring all of them and just focusing on what you say, what your vice chair says, and what the New York Fed president says? And that way the market can better tune out the noise and pay attention to the folks that matter.
I think he would say to that, do whatever you want to do, listen to whatever you want to listen to. And you choose, you be the market participant by just interpreting whatever it is that you want to interpret. But here's what the words that we have to say you're going to find in this FOMC statement. That's the official position. I think, look, Chris Waller was just on CNBC about 15 minutes ago. Saying, I think he said he expects, 2.25 to 2.5 by the end of the year. I think that sounds about right, guys? I mean, I think that's probably where they're, where they're going to be. I don't think they're going to be above 3, but there is sort of this. We talked about this in the past on the Macrocast about that there was a time when you really could do that, Brai, right? I mean, I remember the days of, where, you really only had maybe 2 or 3 Fed governors speaking at any point in time. And even the regional Fed presidents just spoke a whole lot less. There was not all of this talk, so you'd get, you'd have Greenspan and maybe, Myers would be, frequently out, or an Alan Blinder or someone, just like there were a handful that would be out talking, but it wasn't that many. And now it's all of them. And I guess, there has to be some maturation among analysts and market participants, even us. And as we talk about what we think is going to happen in making that decision. And so like, our listeners should listen to you, Brian. I think you have a good perspective that, maybe like your point is well taken. Maybe, people should stop listening to all of these other voices and just listen to what, Powell and a couple of the other guys say. Yeah,
because I do think Powell he continues the tradition that Fed chairmen have had of like trying to reflect the opinions of the board and the FOMC, on a larger basis. And they rarely ever say anything that diverges from that, right? And so if they want to communicate that, hey, here's the direction we're looking at, as a group, it'll be reflected in their speeches, right? Like if you go back to Powell's comments, from the press conference when he says, we will be nimble in responding to incoming data. I think that's a very clear indication that none of this is predetermined. Mm-hmm. Like they have a sense of which direction they want to go in, but I think just between things like Ukraine, the still ongoing pandemic, which everyone would like to act like it's over, but it's not. It's just too soon to predict what they will do. And so I think, to his point, and they did say every meeting is a live meeting. I know the Fed always says this, but I think in this case, it's especially true that it will definitely be a case-by-case basis where they determine, as when they meet and the data they've seen up to that point, what they will do. But it's like driving a car in a storm and trying to get home safely. You don't speed to get home faster, right? You drive slowly and carefully so you can make adjustments on the road based on weather conditions. I think that's what the Fed's doing right now.
Well, look, I think that's to me, I think that's what they say, but I still think that, I think they're saying 2 different things, right? They're saying that we're data dependent. We're saying we're going to be able to see what we see and make a determination as new information comes in, and we're in a dynamic world and all of that. But what is being heard repeatedly, or, I think pretty persistently, is, quarter point rises on a steady step up for quite a while. Yeah. You know what I mean? So so it's not getting, like, if you go out and poll market participants, you don't have to poll them. They're telling you in their reports is quarter points from, either 6 consecutive quarter point rises or 9 consecutive quarter point rises. Mm-hmm. And all I know is that the world changed a lot over the previous 9 Fed meetings. It did not move in a steady line in any direction, right? There was like lots of different whips and turns. We had Delta and Omicron and inflation exceeding expectations and Build Back Better happening and then not happening and war in Ukraine. All these things happened over the last 9 months. And that they're projecting, what the market is hearing is a steady quarter point rise for the next 9 meetings, the next year. And my sense is that the next year is going to look something like the last year in some ways. I mean, you know what I mean? Like, I don't think the market is prepared for a 2 months from now, a 50 point, rise. That would come not as a surprise to the market. It would come as a shock to the market.
Yeah, I agree.
Yeah, and Chair Powell obviously is when he talked about inflation, he focused on the sort of pre-Ukraine situation, which the Fed had thought that first quarter might be the peak as supply chain entanglements maybe get sorted out, but obviously. With this, the expectations for longer inflation that's obviously come into the picture here. We'll talk a little bit more about the reverberations from Ukraine, but it's a kind of a difficult. We've talked about this aspect before. It's a little bit difficult rhetorically for Fed Chair Powell to get up there and say, inflation is really supply driven. We've got some supply shock dynamics, and here's how rate hikes are the right prescription for that. Yeah. I think that his focus really was on, when it came to the growth situation, it was growth is so good, we can focus on fighting inflation and tamping down inflation expectations and not have to worry about growth sliding off. Now, that is going to be that's obviously if we are in a cyclical slowdown and the consumers do get taxed, so to speak, at the pump to the degree that they can't keep up the spending at the pace expected, well, that'll be a very different kind of picture. And that's sort of a crossroads that the Fed might get to over the summer and have to decide, do we forge on with our rate hikes in the face of a slowing economy? That's a much more challenging decision than lifting off right now when growth situation certainly is on side.
Waller said this morning that were it not for Ukraine, he would have been in favor of a 50 basis point hike. Do you guys think that's where the Fed would have been but for Russia invading Ukraine?
We never had 50 as our base case. We always thought that they would have, a more measured response. And I think that, it's hard to say if Ukraine was the decider, but we thought it was pretty likely that they would start with 25. 50 looks just a little bit panicky.
Yeah, I agree. And I think one thing the Fed always wants to project is like calm at the wheel and not being behind the curve. Right? And so I think if they did 50, it would have been an admission that they had some catching up to do. So I would have been very surprised they'd done 50.
But the thing is, what if they do have catching up to do, though, Brai? But what if they do? I mean, you see what I'm saying? Like they're saying like they don't want to panic the markets by saying we have catching up to do. But what if you do have catching up to do? I think it's axiomatic that they are late, not because they're bad people or because they are incompetent. These are really inherently truly difficult things to do. But it's like, you're running the relay race and you're coming around the second turn and you're saying, well, don't run too hard because, people might think you're behind. It's like, you are behind. You got to get to a place. I just think like being clear on communication here should be a brighter goal for the Fed right now than worrying about that kind of stuff. Like say exactly what you mean and what you think and not worry about panicking the market. I don't know. That's my view. That's what I would be counseling if I were there.
I think one mitigating factor maybe to why they're not going faster is to a point John made, and I think we discussed this last time I was on, was that some of this inflation has been driven by supply side issues, right, which the Fed cannot do much about.
No doubt.
That could be one reason why they feel that they don't need to hike rates as quickly because it will not necessarily fix some of this ongoing supply, which has been exacerbated by the Ukraine-Russia, war, and I think the issue in the nickel market is one of the things we're going to talk about later as well, which is an example of that supply side shock, right? And it's like raising rates will not necessarily fix some of these like supply chain bottlenecks, ships being stuck at the ports of LA and Long Beach, etc. So maybe that's that could be one argument the Fed would make for why they're not necessarily going 50-50-50 anything.
But that brings us to another another point on this is that you don't want to you're worried about growth. So now you're worried about growth. So you don't want to dampen demand. At the same time, that the consequence of the Ukraine invasion is to elevate inflation. So you are making a choice again to allow inflation in this moment rather than fighting, truly fighting inflation. I mean, like we know that this is the case. We've seen it in lots of areas, and this is just to emphasize just how difficult it is. When you get this, if you get this wrong, how challenging it is to bring this ship back into the right course. It's really, really tough to do. And I think they're in a bind. I think they're chasing inflation. They're chasing events. I think Powell's motives were absolutely pure. The board's motives were absolutely pure in allowing the economy to run a little bit hot so that people at the lower end of the income scale would do better. Mm-hmm. I think it's absolutely true that we know it's true because we know that the goal of the Fed is to keep inflation modest. So they failed at that, and running hot has contributed to these external these other forces of inflation, fiscal. The huge fiscal support for the economy and supply chain bottlenecks. But the Fed's job, as we know, we say it only has two jobs. Price stability is the number one of those jobs, and so it hasn't met that goal. I think it would do better to get back to that goal. I don't think recession is in the offing if they run a little harder against inflation. I really don't. I think they do need to send a signal that they are very serious about not allowing inflation. And John, I think your point that it was more hawkish than people were expecting, but I still don't think it was hawkish enough, actually.
And it really is in contrast to some of the other major central banks. We saw the European Central Bank come out and they kind of were a little bit hawkish on one hand, as we talked about last time, the potential for them to be shrinking the balance sheet a little bit faster than expected, but then kicking, almost in the same sentence, then kicking rate hikes further into the future. The Bank of Japan came out overnight and said, we're steady as she goes. We're still doing, we're still on the lowest monetary and most ultra accommodative monetary settings. And so this implicates the dollar. When you do have the divergence, you have had dollar appreciation. Mm-hmm. This is part and parcel of the tightening. This is what it's supposed to do. Financial conditions tighten in a lot of different ways. And certainly like getting expectations where they are is tightening in and of itself. We've seen the 2-year Treasury yield and Treasury yields just across the curve going up. Financial conditions are also tightening as, credit spreads are widening here. We're seeing equities, and we had the NASDAQ in correction territory earlier this week. That is in and of itself part of the tightening that people experience. So, the Fed has made its tightening intentions felt, and those are front run in the markets. So it does have that applicability in the here and now.
All right. Well, more to get into in the coming weeks on this as we see how this plays out. I mean, one of the things we did talk about was that Brai referenced is the impact of sanctions on a whole lot of markets. Why don't we take a break and come back and get into that and see how that's impacting our macro economy? You're listening to the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, back on the Macrocast, guys. So we have seen really a historic run of sanctions imposed on the Russian economy, and but I've heard people say we've never seen sanctions imposed on a country this big. We've never seen sanctions imposed on any country. I think of the kinds that we're seeing imposed on Russia right now. Maybe North Korea. It is pretty impressive. It involves official sanctions of the United States and allies, ending economic activity with the country, sanctions on the movement and travel of Russian businesses, Russian people. The movement of the economic transactions that are allowed in Russia, including freezing central bank reserves and shutting off Russia's access to its externally held reserves. Some sanctions involving no-fly zones, access to things like Visa and MasterCard and other technologies, export controls, not allowing the export of technology into Russia. Technology companies then, and many other countries, companies, but while not required, although it makes it difficult to live within a sanctions regime where you don't want to put U.S. dollars into Russia, hard currency into Russia. The reputational risk that a lot of companies have faced have, pulled out their activities in Russia. Also, everything from McDonald's to payment systems like Visa and MasterCard, service providers like Sabre Systems, the plumbing behind transportation and booking networks, you name it. Companies have pulled out to essentially isolate Russia, and it's had consequences in.
And Tony, most importantly, the lads at Chelsea have to take the bus; they can't fly anymore.
Chelsea.
That's a sore subject. Let's.
Brai, you're not Chelsea, are you?
I am.
Yes. Yeah, you grew up there, right?
Yes. I went to secondary school in West London, so I'm blue through and through, as they say.
Well, you're also complicit with the invasion of a free and sovereign Ukraine.
In my defense, I was a fan long before he bought the team, but I will not pretend that I did not enjoy the success. That his money
it's been
brought.
a good 20 years.
Yeah, exactly. Well, you can go back to supporting them now since Abramovich gets zero money from it. So
bids are due today.
You can go blue with a clear conscience now. But so this, these sanctions had some intended consequences, and the intended consequences were to, make economic life in Russia very difficult, not just for oligarchs, but even for through the economy, to send a message to not just elites, but also just citizens of Russia that their country was behaving badly. There were known consequences of this policy that were attempting to be managed. Things like the oil and energy markets, where there were provisions allowed for energy trading and energy purchases, because you don't want allies suffering too much from the sanctions on Russia. Grains, trying to understand what's going to happen with the wheat market this summer is a really important consequence that is expected we're going to have to deal with. Then there are unintended consequences, and I think exposed even some weaknesses in commodity markets is what went on with nickel. I don't remember anybody saying, "Hey, look out for nickel if Russia invades Ukraine." Maybe somebody did it in the Nickel Daily newsletter somewhere, whatever that thing, if that exists, I'm sure it exists somewhere where, the battery guys or someone were saying, hey, keep an eye out for this. But I don't think that's the case, because I didn't see it much priced in ahead of the Russian invasion. Brendan, you've been taking a look at this. Like, what exactly went on here, and especially on the London Metals Exchange?
Right. It was really very much a perfect storm, especially for a smaller market like nickel market. You had, with the Fed tightening and other central banks too, liquidity hasn't dried up, but there's less liquidity in the market than there was before. Then you overlap that with the situation in Ukraine. Russia doesn't make anything, but they do export a lot of rare earths and oil and gas, and nickel being one of them. So 2 weeks ago, the price of nickel doubled overnight. That's not supposed to happen. What you have in market,
it was about from around 40.
We got up to 100,000.
$100,000 a ton. Yeah,
a ton. Yeah, and so both the producers and the consumers of commodities will hedge. That's what the futures markets were originally created for. It was for, farmers in the Midwest so that they could lock in a price on their corn or wheat. But you also have speculators use the same thing to just try to bet on the price of oil or in this case, nickel. So 2 weeks ago, what happened was a stainless steel group in China had an enormous short position. They had it partially because they consume it, but also apparently the CEO was a bit of he likes to speculate in the market, and he had a massive position. Because of the war, prices started to go up, and he started getting margin calls. So then basically it spiraled out of control, and the LME had to shut the market down. And they kind of did the unprecedented where they actually canceled a number of trades.
An entire day's worth of trades,
yeah.
Right? Yeah.
So once the huge spike went up, they canceled all of those trades. That's not really ever supposed to happen. This week, basically the opposite is happening, and the prices of nickel is crashing. And LME again now there's a third issue with the LME, and it's a technological issue. They've had some glitches in the market today, and they again had to cancel a number of trades. But because the price got so high, it got unwound, and now it's crashing because it was artificially too high. But again, for the second time, so they canceled. They had to stop trading yesterday, and they had to stop trading again today. So basically, now I think they're putting a limit of 5, maybe 10% movement.
I think it's up to.
If it's bigger, they shut it down for a couple hours.
Yeah, I think it was 5. I think they widened the band to 8%. 8% per day movement, which gets you which trading is stopping within 40 minutes of open.
Exactly. As soon as you start trading again, it goes down, and they
slams the bottom, and then you go away for another day. I want to get into one point on this of just markets aren't supposed to work. That's not the way markets are supposed to work. But could we just begin with how insane it is that somebody had the idea that with this, what was going on, you look at the world and you say, I'm going to put a massive short on nickel.
Yeah.
Right. It's I don't even understand. I mean, it's just proof that it takes all kinds to make a market. Right.
No, totally. And I think he had it on before the invasion, and it was just so massive, he couldn't get out of it.
Because everybody else knew that was an insane outlook in the world, even if you're right.
To cover your short, you have to sell that short to someone has to buy it, and no one would touch it.
He's in a weird position, though, also because he's in real metal, right? So he
actually consumes it. His company,
so he owns nickel, right? So so he owns nickel, which is rising in value. He had a short on that it was going to fall in value.
Yep.
And so then he's facing margin calls and you can't sell nickel fast enough to pay off your margin call. So he has to go out and borrow money to cover his margin.
So it was a double whammy for him. The price went up because he still has to make stainless steel products, and he lost all his money on the short.
And ironically,
investment banks around the world had to basically kind of come together to loan money to him to save the nickel market. Yeah.
That's right, and he can't sell physical nickel at the top of the market now because it's
exactly.
At what point, as someone who's more of a macro person and is not necessarily follow every all the plumbings of the various financial markets or commodity markets, at which point do we need to start saying, you know what, we need to start treating these markets not so much as financial areas where you're buying or selling or hedging or whatever, or it's a place where people sometimes are just gambling. right? And sometimes they're making ridiculous bets that make no sense, as we've just laid out, as Tony just like really laid out. And someone needs to be there to save this guy from himself, right, before he makes his bet and say, you know what, this makes no sense. We're not letting you go through with this, because on the other end, you could cause a massive dislocation that puts us in the spot we're in right now, right? Like how, like at some point, what mechanism is in place to prevent this from happening again?
Yeah, that's what happened with long-term capital management. They just had massive macro bets and almost blew up the world.
I think to me the lesson is that this is why you want deep, rich, liquid markets, right? I mean, like in bigger markets, it's really hard to take big positions that force this kind of thing. So I would also say I'm not what LME did in the face of this, I think was pretty unconventional. I mean, you know, as Brendan said, you know, canceling an entire day's worth of trades. These were people in the markets who they made trades. There was someone on the other end. There was someone on the other side of every one of those trades, and you cancel it. And that's one thing. That's one thing they did. Then it shut down trading for a week because you think you're telling markets, look, we think the price of the prices are so far out of whack that we need everyone to get their wits about them, breathe, take a moment, reevaluate what they really think is going on with these markets, and then we'll reopen and you can come back and get back to the right price, whatever that is. You know, I mean, what an LME isn't saying we think we know what the right price is, or saying that you guys obviously don't know what the right price is. There are other things going on here, and we need to corral it a little bit and get you guys back on the normal playing field. So they do that, but the problem is you still can't not get in and out of the market. Yeah. And I would just say, if it were a bigger market, if it was, bigger, more liquid, first of all, I think you're less likely to have that problem on the front end of any one short position, causing a problem like that. I also just think that you could allow the market to correct itself a lot better if it's more liquid without having wilder swings in prices. So I think LME was in a tough place, but also I think they need to, they need to figure out some market structure kinds of issues to anticipate, acute short-term market instincts of traders and how they're going to be able to work in those in that place, because it's huge consequences.
I know.
I mean, big knock-on effects of what happens with margin calls is people selling good stuff to pay off bad stuff.
Yeah. That's
what's happening. And so you cause really dislocations in markets, and you have the good stuff paying for the bad stuff, and you don't want to see that. And
especially in commodities markets, where if it's a stock market, if stock goes down for a day, some people made some money, lose it, it'll correct it. But commodity markets, we have to consume these things. So it really does trickle all the way down to the bottom.
That's a really good point. And it goes to something that Brai said, which is, it's bad enough that the nickel market went crazy. When you're thinking about things like wheat and, natural gas in the EU needed to heat homes, that sort of thing. These are also, markets that have experienced some pretty wild swings, some incredible upside in prices. Obviously, speculative elements in there, no question about it. But this is it's a really challenging time. The ability for the world to make up this deficit in wheat that we're going to be seeing, and the ways in which when you look at where Ukrainian wheat went, places like Egypt, that's not a place where food shortages would be taken lightly, and they would have really big real world consequences for people. So it's a really challenging thing.
It really is. I'll tell you, as someone, I sit on the board of World Food Program USA. It's very much on our mind. Not just what will now be hunger, malnutrition in Ukraine, but also this, as you mentioned, John, the knock-on effects of the unavailability of especially Ukrainian wheat on world markets is going to cause real problems for a lot of emerging market countries. Well, we're gonna do a lot more. We're gonna do a lot more analysis. There are going to be more sanctions to come, and I think it's important to remember that sanctions. A lot of sanctions were announced. 1, 2, 3 weeks ago. There were new sanctions announced this week in Europe, and more to come in the United States as well. It actually takes weeks for some of the sanctions to actually be put in place, and actually, so I think we're going to be learning a lot more over the next weeks over what happens in a lot of these markets and how it has a broader economic impact. What do we have looking ahead to next week, guys?
So China on Sunday, they're essentially their Fed funds rate, their loan prime rate. They have a meeting to decide whether to move that. They've held it steady recently, but this week we actually did see some kind of stimulative measures from China, especially after they had a massive tech rout. And then also, so the market PMIs, market's a private company that does surveys, both services and manufacturing. So that'll kind of be our first global data point from March that will encapsulate the Ukrainian situation and how it's affecting growth. Other than that, it's a pretty quiet week.
Yeah, that's good. We could use a quiet week.
Yes, exactly.
Although I am curious, I know this tech is going to fall within the next week category, but I do know there's meant to be a call today at some point between President Biden and China President Xi.
Yeah, it just started.
Yeah, okay, exactly. So I'm curious to see the outcome of that and what knock-on effects that has going into next week.
That's a really good point.
All right, guys. We'll look forward to that. Brai, great to have you back on again this week.
Thank you for having me.
Have a great weekend. Looks like I think most of us are going to have good weather this weekend, so get out and enjoy it. Have a great spring weekend. We'll see you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.